Hi everyone, welcome back to my channel Fast and Curious, where we simplify complex financial concepts for you. Today we are talking about price to earnings ratio, also known as PE ratio, one of the most essential tools for stock market valuation. It's like a price tag for a stock, helping you decide if it's a good deal or overpriced. But don't worry, we'll break it all down for you. And before we dive in, hit that subscribe button and tap the bell icon so you don't miss future videos. So let's start with a simple analogy. Imagine you are at a market buying tomatoes. One vendor is selling tomatoes for rupees 30 per kg. You'd ask yourself, are they worth it? You'd consider things like quality and availability before deciding. Now imagine paying rupees 100 for organic tomatoes. Great quality and higher demand, but expensive. Or getting tomatoes at a low price when supply and demand is surplus. Sounds like a bargain, right? Just like this, stock market uses the price to earning ratio to determine if a stock is expensive or cheap relative to its earning. The PE ratio helps investor evaluate whether they are paying a fair price for a stock. But wait, before we calculate PE ratio, we need to understand EPS or earnings per share. EPS tells us how much profit the company earns per share. It's like finding out quality of those tomatoes you are paying for. EPS formula is net income minus dividends on preferred stocks divided by average outstanding shares. Think of EPS as the foundation for PE ratio. Higher EPS means higher profitability and helps us measure whether a stock is worth its price or not. So let's start with the basics. What is PE ratio? The PE ratio or price to earning ratio is one of the most widely used metrics to evaluate a stock's valuation. The formula is simple. PE ratio equals market price per share divided by earnings per share. In simpler terms, it tells you how much investors are willing to pay for every rupee of a company's earning. So, why does it matter? The PE ratio helps investors figure out whether a stock is overvalued or undervalued. It also reflects the market's expectation for the company's future growth. Think of it like shopping. If one store sells an item of rupees 50 and another of for rupees 100, you would wonder, why is one more expensive? Is it better quality or is it just overpriced? The PE ratio helps answer similar questions for stocks. So now let's talk about types of PE ratio. Did you know there are different ways to calculate and interpret PE ratios? Let's break it down. First, we have the trailing PE ratio, which is based on a company's earnings over the past 12 months. It uses historical data, making it a reliable measure of actual performance. Next is the forward PE ratio, which is based on forecasted earnings. It reflects the market's expectations for future growth. However, keep in mind these forecasts can sometimes be optimistic or even inaccurate. Finally, there is a relative PE ratio, which compares a company's PE to its industry average. This helps investors see if a stock price is overvalued or undervalued compared to its peers. Each type of PE ratio offers unique insights. Combining them can give you a fuller picture of a stock's valuation. So now that we know the types, let's interpret the PE ratio. A high PE ratio often means the market expects significant growth from the company. On the flip side, a low PE ratio could mean the stock is the stock is undervalued or there might be risks involved. So let's classify PE ratio using our trusty tomato example. Just like tomato prices, PE ratios can indicate whether a stock is overvalued, undervalued, or fairly valued, depending on the situation. First, if the price of tomato rises from rupees 10 to rupees 30 per kilogram, but the quality hasn't improved and the demand remains the same, this reflects a high PE ratio. It suggests the stock or tomatoes in this case might be overvalued. On the other hand, if you find tomatoes at rupees 10 per kg, which is a better quality than those priced at rupees 30, this represents a low PE ratio. It indicates that the stock or tomatoes might be undervalued. But if tomatoes cost rupees 100 per kilogram because they are organic, of excellent quality and have high demand, this reflects a high PE ratio that's fairly valued. The price justifies the quality and demand in this case. Lastly, if tomatoes cost rupees 10 per kilogram with the same quantity and demand as others priced at rupees 50. If the other vegetables are at rupees 50 and the tomatoes cost rupees 10 per kg, then tomato as a sector is a low PE vegetable with fairly valued. So the key takeaway is understanding PE ratios, just like pricing tomatoes, requires context. A high or low PE ratio doesn't tell the whole story. Always look deeper. Let's look at the advantages and limitations of PE ratio. Like every tool, it has its strength and weakness. First, the advantages. The PE ratio is incredibly simple to calculate and easy to understand, thus making it a go-to metric for beginners. Plus, it's useful for comparison across sectors and industries, helping investors identify opportunities. But the PE ratio isn't perfect. It doesn't account for a company's debt or growth rates, which can lead to misleading valuations. And if the company's earnings are negative, then the PE ratio becomes tricky or even irrelevant. But here's the key: context matters. A low PE in a strong company might indicate a hidden gem. Meanwhile, a high PE for a hyped stock could be a red flag. And that's a wrap. Remember, the PE ratio is just one tool in your investing toolkit. Always consider the bigger picture. If you found this video helpful, don't forget to like, share, and subscribe to my channel. Let's continue the journey of financial learning together. See you in the next video. Thank you.